Alright, welcome back everybody. Next up is our team, all the way down from Laramie. Team from University of Wyoming, Cowboys. On stage.
Good evening. Thank you for attending our investor presentation on Vail Resorts. We are the University of Wyoming, and we are recommending a buy with a potential upside of 25.7% return at $350 a share. My name is Liam Holt.
My name is Sean.
My name is Apama.
And I'm Juliana. So Vail Resorts is a ski resort industry. They trade under the MTN ticker. They have 37 resorts spreading across North America and Australia. And they have split their revenue into 3 different segments: mountain, lodging, and real estate. They provide services like the Epic Pass, the ski resort day lift tickets, rentals, and lessons and lodging and the amenities that go with that. So as environmental, social, and governance become more important to the customer and to the investor, we decided to start off with ESG. Vail Resorts is currently initiating a program called the Epic Promise Program to achieve net operating footprint by 2030. Their 2021 report on this says that they are well on their way to achieving that. They are guided by 7 values. Their most recently adopted value is be inclusive. They adopted this in 2020 to drive diversity, equity, and inclusion, and we believe that this will open the door to some demographics that they do not currently reach. Their CEO, Kirsten Lynch, is the only woman CEO in a Fortune 1000 company in the travel and leisure industry, and their board of directors is a 10-person board with a even 50-50 female-male ratio.
Thank you, Juliana. Next, I'd like to talk about the ski industry a little bit. So there's 462 resorts currently in operation in the United States. That kind of means that the threat of new entrants is relatively low. There's very high barriers to entry, including cost to purchase resorts or cost to purchase land on which to build a resort. Additionally, I'd like to mention that Vail is the largest owner in North America of resorts. Their primary competitor is Alterra. They sell the Icon Pass. However, Alterra does not own all the resorts which they operate. They operate through partnership agreements with different owners. Additionally, there are 57 million skier visits, and that's an average over the last 3 years.
So we developed our recommendation for a buy on 3 main pillars. The first pillar is Vail's market dominance and the expansion opportunities that come with it. The second pillar is the hub and spoke network of resorts, which creates diverse offerings for multiple customers. And the third pillar is the subscription model, which they have adopted to improve revenue structure. To begin with, the first pillar that we established our buy recommendation on is Vail's sheer market dominance. They currently have 54.6% of the market share. And as you can see, this is clearly above and beyond any of their other individual competitors, which we believe will enable them to have broad expansion opportunities, which they are currently pursuing in acquisitions.
Our second pillar is their hub and spoke network. So what Vail's been able to do is acquire a number of resorts located near population centers. And they also own a number of resorts that are located in the Rocky Mountains and Canada, as well as California. So what these smaller resorts do next to the population centers is attract new customers who might be willing to spend, $300 for a season pass, but now they're going to buy this Epic Pass where they can now go spend a week as well at Vail and ski at their local resort. And when these customers go to these destination resorts, they're going to spend a week and they're going to spend more money. Our third pillar is their subscription-based revenue. So what Vail offers is they have their Epic Pass products. The top tier sells for about $800 and the second tier sells for about $600. Below that, you can find any number of pass products depending on how often you want to ski or what your regional location is. This creates customer retention, as customers are more likely to come back year after year once they purchase a pass once. and it also gives the company prepaid revenue.
Thank you, Sean. This leads us to our projection methods. All projection forecasting was based off an 8-year historic financials. As you can see, the lows of 2020 and 2021, we did incorporate those with a weight, as well as using the years prior to that, 5 years prior to that, of 2020. All of these were used to project a 5-year to the fiscal year of 2027. In 2022, we projected a 32% growth rate for revenue. This is to stabilize and recover Vail's revenues from those COVID lows. Then carrying into the following 2 fiscal years to 2024, we project a 9.8% growth in revenue, and the final 3 years are at a 5.8%. These projections allowed us to confidently estimate a stock price using our first valuation technique, and that is a discounted cash flow model. We used the forecasted cash flows from our projections, as well as the 9.76% weighted average cost of capital, a 3% terminal growth rate, and a 12-month EBITDA multiple for fiscal year 2022 of 17. These paired with a perpetuity approach and an EBITDA multiple approach carried us to the final DCF valuation of $366 per share. The DCF is then supported and tested using a sensitivity analysis in which we incorporated a multitude of variables, those all centering around our 3, the terminal growth rate, EBITDA multiple, and weighted average cost of capital.
As we mentioned earlier, Vail Resorts have divided their operations into mountain lodging and real estate, which bring in 89%, 11%, and 0.01% of total revenues each, which is why we decided to use a sum of part valuation to forecast their upcoming revenues. Firstly, we used their latest closing share price, January 21st, 2022, and their total outstanding shares to calculate the company's total equity value. Then we took a 5-year average to calculate the 4 multiples that we will be using to forecast our financials. And our reasoning for using a 5-year average was to offset the revenue fluctuations that you see on the column chart on the right-hand side. So using these 4 multiples, we were then able to forecast revenue assumptions for mountain lodging and real estate. Combining these, we can get the total value of the company. Then we took an average of all 4 prices per share and landed at an average price of $348 for Vail. Now, to give you a summarization of our valuation technique and also give you a visual representation, we have also plotted a football field valuation. We took our 3 main valuation methods and took an average of our price per share and landed at a target price for Vail Resorts at $350.94. Using our current price of $279.16, we are estimating a 25.7% upscale growth potential in Vail Resorts, which is why we believe that they are an opportunistic investment. Okay, thank you. For a fairly seasonal and fluctuating industry, Vail Resorts have been able to keep their investment risk very low scale. On the left-hand side, you see a risk matrix that shows you the probability and impact scale for all of their main investment risks. The seasonality of their business, along with natural disasters, are mitigated by the diversity of their location and the availability of snowmaking equipment. Along with that, non-ski summer activities and a brand awareness of the Epic Pass has allowed them for continuous customer and revenue generation throughout the year. Competition is fairly low as they dominate their market and there are high barriers to entry. Along with that, they are in compliance with all government regulations and they work very hard to keep up with environmental laws and also improve the resort and ski areas that they are developing in currently. So, to conclude, Vail Resorts already has a giant footprint and is one of the leading companies in the ski resort industry. The main points that we mentioned, such as the share market dominance, their subscription-based revenue model, along with their improvements to their products and services, such as the Epic Pass, allows us to give them a recommendation of buy. Thank you, and please ask us any questions that you like.
They're no longer any publicly traded direct competitors to Vail, and any direct competitors are really themselves at this point. What does that tell you about the challenges that Vail faces?
Yes, it does give them the dominance in the market. We did compare them to here we just have 4 companies. I segmented those into theme park and casino side of entertainment. They do have a higher correlation to the highest, actually, with other publicly traded companies for comparison. As you can see, this is a forecast using each company's financials. Going forward, the main bottom line looking here is the EBITDA margin here at 32% for Vail. I averaged them from theme park to the casino. Casinos do tend to have closer correlation to Vail's revenues as they are segmented as well between the casino business and resorts.
And I think to add to this point, as you mentioned, there's not a lot of publicly traded companies, but just given their share market dominance, as you saw, they are over 50% owners of the ski resorts in the North American region. So based on that and the history of the business and their revenue generation, brand awareness of their resorts is what leads us to believe that they are a strong competitor in the industry.
Regarding valuation, you guys hear me?
Yeah, we got it.
Regarding valuation, so I'll use my phone. Can you hear me? Let's have this one. There we go. So regarding valuation, great push on trying to have different methodologies in addition to your DCF. My question is, why did you go with the sum of the parts? Do you really think it's warranted here? Is it adding additional insight or a different perspective on how to value this company? Why didn't you use a relative valuation approach with some of these other comparable comps that you have on the screen right now?
Well, we used our sum of parts valuation because, as I mentioned, they have divided their operations into mountain lodging and real estate. So we kind of wanted to give you an overview of what their dominant their dominant revenue stream is. But the reason we did it, as you can see, mountain, which includes their ski rentals, the schooling and the equipment part of the resort area is what brings in the most revenue. So this lets us know that if improvements are needed to be made, we should focus on mountain first, lodging next, and real estate after that. So it kind of was a way to give you a visual representation of what we believe is the most important revenue stream for Vail Resorts, which is why we do some parts allocation. And also to see where the revenues would take us, where investment is more necessary in the future. For example, real estate, they currently are investing in more ski areas around the East Coast, I believe. The Seven Springs Resort, so stuff like that is what we want to reflect our sum of parts valuation.
What kept you from a relative valuation approach?
Well, because a lot of other ski resort areas were not publicly traded, and other companies that also give ski resort passes are also not publicly traded. So just the lack of information available is what kept us limited from doing the relative valuation. It is something that we wanted to try, but it did not seem worth it with the data that we had available.
One of the things you guys brought up was that Vail's strategy is to own the resorts, where Altera looks to do partnership agreements. Just curious what your thoughts are. What do you think is a better approach for this industry? Is it beneficial to own the resort to take on all this capital and have a large balance sheet? Or is it better to be more nimble and just partner up with the resorts?
I'll give you a good lawyer answer, it depends. I think it's a good combination to do both. And that's what Vail is doing. So they own most of the resorts that they operate in the United States. However, they do have partnership agreements in Europe and Japan. So I think a good combination of both those things is what might be the best in the industry. I do think it will consolidate though, where the people that are selling the passes like Alterra's can end up owning more of the resorts, cruising excursions.
And just to follow up on that, on consolidation itself, do you guys think it's possible that Vail could buy out? You had a slide showing, I think, 4 or 5 other comparable companies. Is it possible that they could buy out Boyd? Do you see that as a likely possibility in the next few years?
I think, is anyone else want to take?
I mean, I think that they will probably offer and attempt, but in general, it is probably better to have some sort of market diversity out there and a competitor. So I'm not sure if it would be most wise to try and absorb the entire market.
Just a quick one, the market share, is that based on number of resorts or acres or what?
Yeah, that is based off revenue for our program.
Thank you.
Another question about market share. What is, in your analysis, kind of the trend direction of their market share? Is it increasing year on year, or how is their market share fluctuating over time? Where is it?
I see it as increasing, especially with their focus on acquisitions. They have made goals in 2021 to try to acquire a few new resorts, including the Seven Springs, which we mentioned earlier, but that came with and 2 other resorts that they are trying to acquire. So I foresee it still trying to grow.
And to add to that, I think you will encounter a difficulty eventually with skiing. The number of skier visits, as I showed earlier, at I think 57 million over the last 3 years, that's not a substantial increase, and it's actually down from a peak. I think in 2010 it was at 60 million skiers per year, and that was even before COVID. So I think eventually to continue to gain revenue market share, they are going to have to raise their prices eventually, but at what cost to losing customers?
If you look at the board and a lot of senior management, they're pretty deep on the marketing side and analytics and that sort of thing. What would you say about senior management's capabilities operationally? And what have you, I assume there's some skiers up in Wyoming, what have you gleaned in terms of how they're doing operationally?
That's a great question. We haven't gone that deep into the board's particular specialties with each one of them. We know that they have the 6-person committee that governs their decisions and tries to keep them in compliance with everything. So in regards to operations, I think that Kirsten's going to do a good job, but Mala has more to add.
Just to add to that, I do believe they are doing a good job, but I feel like they do need to focus a little bit more on marketing. During our research, we did see that they are currently facing some social media flashback due to their current operation, that the lift lines are too long, the customer service is not that good. So small things like that are definitely in need of improvement, but I feel like the feedback that they are currently receiving is a good way for them to establish and start improving how they structure their ski lines, or how they structure their schooling, or how they structure their customer service and stuff like that. But I definitely believe they need to focus a little bit more on that thing.
Yeah, and a final point, operationally, I think they've been working on it. They've developed an app that can kind of show you what your wait time is going to be at a certain ski lift now. Additionally, they are putting some capital investment into lift improvements, so the lines will move quicker. See positive things.
Last question.
So regarding ESG, you had a fairly positive assessment in the firm. What are they not doing well, if anything?
I think that it was late in 2020 when they adopted the Be Inclusive value, and I think that that is some foresight on their part that they are weak on serving certain demographics that they could be improving upon. They are trying to start new programs that will invite groups that they don't normally see on the slopes to feel welcome and to find Epic and the Vail Resorts as a home on the slopes. And so I think that they see that weakness, but they are trying to address it.
And I think there's a problem in the ski industry as a whole. If you look at the demographics of skiers, it's predominantly white, I think like 90%, and young and male. And you can look at that as an opportunity for Vail. Like, can they reach those lower income demographics? Can they reach minority demographics? Can they get those people to be part of the skiing culture? I look at that as an opportunity for them, and hopefully they'll address that.
Awesome, thank you.